What comes first, market downturn or drop in consumer confidence? I've been talking about this for years, and really in my mind, consumer confidence drops and it causes the recessions, it causes the downturn in certain markets. Hi guys, I'm Boris Dorfman with LBC Capital Income Fund. I want to give you a quick economic update. I've been doing this more often, and as of late I've been more wrong than right. It's very difficult to forecast when the government acts irrational. But lately, not always, for the past few years, the consumer sentiment has been so bad and people have been so off. But in reality, what happens if we think that the markets are going to turn, we wait. We stop spending. If we expect to lose a job, we stop spending today. We turn on the TV and it tells us on TV that things are going to be bad. We freak out. We stop spending. Of course, COVID threw a big wrench in it because people were sitting at home for 2 years. And in fact, some of these people, they never learned how to spend, but when COVID stopped, they went out and they started spending like they never had, and there's no stopping them. I've been hearing this word stagflation a lot over the past few years. What is stagflation? It's a relatively new term and nobody knows how to define it. You can go to Wikipedia. I mean, it's not a novelty, it's in economic books, but from what I understand, this stagflation is meant for periods of long inflation coupled with weak economic activity. But calling for, I don't think you can call for a long-term phenomena before it happens. Again, consumer, business confidence. Things are good, guys. If you go out there, I just came back from San Jose. Restaurants are full. You have to be on a wait list. Restaurants are expensive. Rents are expensive. Things are good. You don't see full restaurants, movie theaters, stores, low vacancy rates on rentals when things are bad. We saw that there was a severe downturn in the economy in 2008, 2009, because the restaurants were empty. People were putting their purchases on hold. Elective surgeries were put on hold because people were not sure if they'll continue to have income. Something slowed down in the past few months, year. Used car prices have dropped in price. New car prices are still elevated. Well, these are MSRP prices, but today you can actually go and get most cars, not all. It wasn't the case a few years ago. But things are slowing down, and that was the idea behind the interest rate hikes. But things are not gloom and doom in the economy and also in real estate market. There's a lot of wait and see game in real estate market, especially commercial. There's a lot of buyers out there, but they're looking for prices to drop or cap rates to adjust. Sellers want to sell, but they're holding out for prices, same prices as they were today. So not a lot of commercial real estate are trading hands, but there's still a lot of activity in residential real estate. And the biggest factor is low inventory. I just read a report today that today's single-family inventory is lower than at pre-COVID levels. So you would think much higher interest rate would bring drop in prices, and they should, but there is no inventory. Sellers are sitting on 2.5%, 3% interest rates, and they don't want to drop prices. You drop prices and you lose that rate. So there is no point for a lot of people to sell. We will see a lot of movement, especially in commercial, and then we'll see some prices adjust. I think so, but it's not gonna happen overnight. I don't see stagflation, nor I know what stagflation is. I don't want to tell you guys that everything is peachy, but they're not bad. There's definitely no gloom and doom. I see interest rate adjusting on adjustable commercial mortgages, and some people will be forced to sell and they will be taking a discount. We will see some discounted real estate. We may see across the board drop 10%, 5%, 15%. We already see some neighborhoods experiencing price decline, but yeah, things are good. And the major thing, employment market, labor market is still very resilient, and that's probably the thing that Fed is waiting for until they start raising and start dropping the rates. So the economy is still strong, employment is still high. Some of these numbers are probably a little bit not true and elevated, but not by much. I thought maybe 6 months ago that we'll see lower interest rate by the end of the year. I don't see Fed dropping rates by the end of the year, but maybe beginning of next year. Consumer price index and personal consumption expenditure readings, inflation readings, CPI and PCEs, they're much lower than they were at the same time 9-12 months ago. So as they drop further, if they drop further, we'll see normalization. The Fed will be at ease, and they will start considering lowering the rates, but I think we're maybe 9 months away from this. So turn off your TV, stop listening to the news, analyze, and most importantly, ask yourself, where are you running to? Maybe take a step back, reevaluate, and see what do you want to happen, and how are you prepared for that economic or market event. Make sure your investments are diversified. Make sure that portion of your portfolio are invested in our fund. But don't rush, and things will be okay. If you need to buy a home because your kids are need to go to a new school, make plans, go to your mortgage advisor, see what your payments will be, and go for it. But if you want to make moves for the sake of making the moves, I'd say probably at this point wait or see a displacement in the market for commercial transactions, investment transactions, and see where you can take advantage of that. But to do that, you need to be ready. You need to have your mortgage approvals. You need to have your cash ready. Yeah. Thank you, guys. I'll see you next week.